I don't like it when investment bankers talk about Ebitda.
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 Ebitda. Ebitda.
Ebitda. Ebitda. If every time you saw that word, you just substituted the phrase bullshit earnings.
So what the hell is Ebitda anyway? Is alternative finance all one big sham? Is it just all useless? Or is it just a way for finance people to feel important and be arrogant per usual? But jokes aside, I think that some of these accounting measures and accounting best practices sometimes give an unrealistic view because they're there for tax purposes. For a financial perspective, we want to be able to use some measures to peel off some of those accounting layers and see more of a true performance and true metrics of the company. Again, that's why I want to get into some of those financial metrics. You might have heard it, things like EBT, EBITDA, EBITD. There's always a variation of that. So let's talk about it for a couple minutes, because you might think that, wait a minute, we have this income statement, we have our net income, we have our expenses, we have all these measures. Why do we need to go into these alternative measures? Well, here comes the duality of a financial statement, because when you prepare your financial statements, it has to be viewed by multiple people. First of all, it goes to Uncle Sam. Taxman or taxwoman sees it, so you want to get those tax benefits, but at the same time, your investors see it. They want to make an evaluation about your company. Is it worth investing in? Also, your underwriters see it. When you want to go to a lender and apply for a loan, for the most part, they're asking for financial statements. So you have this duality with your financial statements where you're preparing them to the IRS, but at the same time, you're going to folks who are looking at performance of your company, which are mostly investors, the public, if your company is going public, or lenders. So you want to make sure that there are measures that accurately represent what your earnings are. So here are all the elements of this financial metric. You have earnings, which is net income. We call it earnings because that's the money you earn. Again, you get to take a look at finance and how finance people think. So E stands for earnings. You have before, and then you have interest, taxes, depreciation, and amortization. These are all the elements you need to know. What's the reason that we do earnings before these? Well, from a finance perspective, the idea is that, well, things like interest on a loan, taxes, depreciation, amortization, they're not very either tangible or they're a true reflection of company's performance. What does that mean? Well, let's go through each of it. Interest is the cost that you pay to borrow money. And from a finance perspective, they say that, well, it's not the cost that your operation is causing. Well, sometimes we want to see how much is your earning before interest. Same things with taxes. Taxes can change based on the state or the country you're from. So it's not really up to the company to do that. But sometimes in cases, we want to know how the company is doing, how the operations of the company are, how efficient the company is. Well, taxes can sometimes muddy the water. So why can't we have an opportunity to deduct taxes and just have earnings before taxes so we can see how the earnings are without government taking a chunk? In accounting, there are two methods to perform accounting. One is cash basis. The other one is accrual basis. When it comes to cash basis, this is based on transactions that already happened. So you essentially are a bookkeeper, you open the bank statement for this business. You're like, oh, these are the posted dates. So I'm going to categorize them based on posted dates. These are what happened. So in technical terms, you're recording transactions based on the date they actually happen, versus accrual basis where you are categorizing them at the time and when they were accrued rather than when you actually receive the cash. For example, if you're a plumber and you go to someone's house, there's expenses, you fix their bathroom, you do the work that you need to do, and you give them an invoice and you just go. Well, a couple of things happen here. One is that you accrued some expenses that you either paid for already or you're yet to pay for. For example, getting supplies from a supplier, they send you a bill. Well, you accrued that expense today from an accrual basis, but from a cash basis, it'll be in your accounting, it'll be in your books when you pay it. Same thing for revenue. From an accrual basis, you earned revenue today. So the way the journal entry is that you debit accounts receivable, but from a cash basis, you haven't received any cash yet. So when we're discussing cash basis is whenever this customer pays the invoice, the money is in your account and cleared, that's when you record it. And again, for real estate, when we want to discuss, real estate has been mostly on a cash basis, meaning that you go in, you collect the rent, you deposit it into your account, you pay the bills, you take care of what you need to take care of, and then either you or your accountant go back and look at the bank statements and record everything they need to do. as opposed to accrual basis is that when you record a transaction when it was accrued as opposed to when it was received. So with that being said, we want to discuss depreciation and amortization. Both of them are very similar with some minor differences. Depreciation in a sense is spreading out the cost of an asset over its lifetime. Meaning if you bought an asset that has a lifetime of 10 years for $10,000, you get to depreciate $1,000 each day until it gets to the salvage point. The difference with amortization is that while depreciation is for actual tangible assets, meaning property, plant, equipment, the things that you have, things that are real or that you can touch and feel. Amortization is for intangible assets. What is an intangible asset? Well, it could be a professional license that you have. It could be a trademark that you have on your logo or your name. It could be that a copyright you have on your PI. These are all intangible assets. They're your assets. They have a cost to acquire and they have a lifetime. So you can amortize the same way. For example, if you have a 3-year trademark and the cost to acquire that was $30,000, well, you can amortize $10,000 from that asset each year. Again, this is very simplified. There's a lot of nuances with that, but just it's for you to understand the concept. The another difference is that depreciation always has a salvage value because it's a tangible asset, while the intangible assets don't. So we want to exclude that because these are something that can help us from an accounting perspective say that, hey, I acquired this asset, it's depreciating as time goes by, which happens. Your trademark depreciates, your car depreciates, your property depreciates. These are real life scenarios. Your car has wear and tear, the engine's working, the cylinders are working, they're aging. So depreciation is very real, but from an accounting perspective, you can actually expense them. However, when it comes to financial performance, we want to see that, hey, what are the scenarios that we can pick and choose which one of these to eliminate so we can get a better look at our earnings in different scenarios. One of the favorite ones that a lot of companies use is EBITDA. That's earnings before everything. Interest, tax, depreciation, amortization, because we want to see what is our net income if these expenses or these costs didn't exist, to just get a truer value of our company's efficiency and earning, and also it helps with evaluation as well. It's just a simple way to peel through those accounting layers, as I said. So just think of that as maybe a just different way of looking at things. And it wouldn't be a good video if we didn't discuss real estate in a way. Obviously, NOI and EBITDA are kind of not the same. And again, you might ask, well, we discuss NOI a lot, which if you want to know more about it in cap rate, here's the link. You might ask, well, is Ebitda the same thing as NOI? Well, the answer is not quite. When it comes to NOI, especially for real estate, we're looking at NOI as core costs to operate a property. So it doesn't take into effect other operating expenses that have nothing to do with the property. Let's say you have a holding company and you have multiple assets under you and you're managing them. When it comes to calculating NOI, you have to actually calculate NOI for each property when you want to determine cap rate, but you have other expenses. You have your office, you're paying rent, you're paying wages for employees to do administrative work for you, you have advertising and marketing expense. Those are not calculated towards the NOI for the property, but for Ebitda, they are calculated in it. So the difference is that there's some expenses in Ebitda that are not existing in NOI. So NOI is a measure that has a higher margin usually because some of those expenses are not included. But obviously running an operations or products or services business is different than running a property. I just want to make sure that you understand the difference between both. And when you're using EBT, EBITDA, Ebitda, things like that, they're mostly referring to businesses that are operational, offering products and services. Yours do as well, but when it comes to actually providing financials for your building, make sure that you stick with NOI.
Last but not least, I wanted to discuss the issue that Warren Buffett, Charlie Munger, and a lot of very fundamental investors have with Ebitda. And it seems like they believe that Ebitda is not real earnings because they take the real earnings and they deduct very vital expenses from it, expenses that you would want to know about a business, and deduct it so they can just have a better earnings report and therefore have a padded record for their evaluation. And this is also a contributing factor to how the tech evaluation is so high. And they believe in that removing very important expenses like depreciation and amortization is wrong because these are real expenses. You have to have it in your earnings report, and your earnings should reflect how much you are making as a net income, including depreciation and amortization expense. So while you're looking at Ebitda to evaluate a business, just be careful because you have these investors who've been in the business for such a long time. They paved the way for us to learn how to invest in a company, learn how to invest in a business. And the last thing that we want is some investment bankers use financial information that is not true to sell you shares of a company that is not doing as well as you think they are.
I know it's a lot to take in, but these are really good information for you to have. Obviously, this is not making you an accountant. You always want to have a good relationship with your CPA, ask them a lot of questions. But if you're buying a business, if you're buying a real estate holding, if you want to evaluate a business to invest in, these are fundamentals. Remember, TikTok investing is cool. The Lamborghinis, the cars, all the bling, they're all nice. But in order to achieve those, you have to learn fundamentals. There's no way around it. So this income statement is one of the most important and fundamental financial statements in all finance. So learn them and become a very savvy business owner or investor. Thank you so much for watching. It's been a lot of fun. Tell me if you have any other statements or any other fundamentals that you want me to discuss. It doesn't have to be real estate. It can be business as well. I work with a lot of small businesses. Lately, my career has been very focused on small business. So if you want to buy a small business, start your own small business, let me know what topic works for you. But in the same time, if you want to know more about efficiency ratio, a really cool ratio that measures if you're making enough sales, are you using your assets, watch the video up here. For my real estate folks, I made a video on the market, scary real estate market shift, market crash, all these terms are coming in. I made a very long video dissecting our market. Watch it here. Other than that, thank you so much for watching and keep learning. See you next time.